Hello friends, Chris Lee, CPA here, back with another video for you. And today we are going to talk about tax depreciation and specifically some of the benefits and considerations related to the different types of accelerated depreciation that we have for tax purposes. So getting right into it. So when it comes to accelerated depreciation, we have two options, and those two options are section 179, which is kind of the old rule that we will have seen for many years, and it's kind of like always existed. It used to be at a pretty low level, just allowing $25,000 a year, and then for probably 15, 20 years now, we've seen it well above $25,000 of an annual availability. And then we also have bonus depreciation. And so this is what's getting a lot of the big news coverage of being able to accelerate a bunch of depreciation. And we'll talk a little bit about why that is, but then the considerations around when we might choose to, not accelerate depreciation and all those sorts of things, and when 179 might be better versus, bonus depreciation or that sort of thing. So getting into it now, bonus depreciation has been bumped back up to 100%, which is to say 100% of the assets per cost basis, what you pay for it. An asset that would typically be capitalized, recorded as an asset, not expensed immediately. For those that are, purchased and placed in service after January 19th, 2025, are eligible for the accelerated depreciation of 100% of the cost of the asset. So it creates a big quote unquote write-off in the first year. And so that includes, so this applies to, assets that have less than a 20-year asset life. So this would be, equipment, computer hardware, certain vehicles, and, commercially available software, furniture, all that sort of stuff. So anything that's kind of like, not a, real estate asset or structural component of a real estate asset, that's what you'll find, see where bonus depreciation mostly applies. Now, bonus depreciation does also apply to real estate where it is considered a qualified improvement property, improvement. So, it's basically defined as an interior portion of a non-residential building that's been placed in service. So the expenditure is attributable to like an enlargement of the building, or anything structural like elevators, escalators, anything related to the stairs, moving about the building, or internal structural framework of the building are not considered qualified, improvement property for bonus depreciation. So you don't get to elect it on that. So that's functionally what it is. Bonus depreciation really is like it's an all or nothing based on the asset category. So we've got different assets that are defined, 5-year life, 7-year life, 15-year life, all those sorts of things. Bonus depreciation applies to everything in that asset class. Like all assets that are 7-year for the year must either all take bonus or no bonus, by asset life. You can also elect out a bonus of every asset life if you so choose for certain reasons. And you might do that if you expect tax rates to be, higher in the future. And what you do when you choose to defer a deduction to a higher tax rate year is that you get the benefit at a higher tax rate. So $1,000 deduction at a 37% tax rate means more than $1,000 deduction at a 22% tax rate or a 12% tax rate, that sort of thing. And so because in 2025, the rules that we had, understood prior to the passage of the One Big Beautiful Bill legislation, we understood that there was going to be, a 40% rate. They did allow a transition period where you could actually elect the 40% rate for, tax year 2025. And so you can elect that, and you might choose to do partial bonus depreciation in 2025. And this is now that we're basically near the tax deadline, this is something we could consider if we've extended our tax return and that sort of thing. But that's functionally what bonus depreciation has the rules for us. Now, Section 179 is, better and worse in some ways. So the first piece of it is that it has kind of an annual cap. Bonus depreciation, no annual cap of what you can deduct. Section 179 has an annual cap of what is allowed to be deducted under Section 179. And then also it has that annual cap can be reduced if you have too many assets placed in service. So it starts to phase out. So for 2025, we had a $2.5 million annual cap that began to phase out for every dollar for dollar when assets placed in service are in excess of $4 million. So that's to say, if you put in service $4,100,000 of assets, then your annual allowable deduction of $2,500,000 gets reduced by the $100,000 excess. That is the $4,100,000 minus the $4 million. That is a $100,000 excess. That reduces your 2.5 million cap, so that goes to 2.4 million. So if you put enough assets in service, you'll start to see a reduction in that available phase out. And so, large corporations basically don't use Section 179 because they're always putting in service assets more than, $4 million or whatever. What they usually will be doing is, relying on bonus depreciation because there's no, asset placed in service item there. Now, Section 179, in addition to its annual, cap that can be reduced, the availability of the deduction also relates to the business income. So there are several limitations that go into what creates the allowable Section 179 deduction. And so that's the thing that can be kind of interesting about Section 179. It's much more of a math exercise. So that's the thing to it. So Section 179, much like bonus depreciation, applies to equipment, computer hardware, peripherals, commercially, kind of all that general stuff. But then it can also be claimed for those real estate improvement properties and for roofs, HVAC equipment, fire protection, and like alarm systems. So that is, the special thing of it. And and security systems for non-residential real property, and for the personal use property used predominantly in connection with, a lodging business. So let's say that. So the thing about Section 179 is that when it comes to vehicles, it's much more restrictive than bonus depreciation. So Section 179 deductions for heavy SUVs used over 50% do get these special limitations. And so then for tax years, 2025, the maximum Section 179 deduction for a heavy SUV was only $31,300. For tax year 2026, it's $32,000. So people need to be conscientious that Section 179 itself does not give you the big benefit. It's usually the combination of Section 179 and bonus depreciation that's giving you these large benefits on vehicles. And that's the thing to know too, is that you can claim both Section 179 and bonus depreciation. The order that it goes in from when you're claiming kind of both on an asset would be, Section 179 is applied first, then bonus depreciation, and then your standard, what we call maker's depreciation, modified accelerated cost recovery. So that's, the certain percentage that we get every year. So so you kind of wonder to yourself, what's the big difference? And really it comes with the fact that Section 179 has phase out rules where you can be totally phased out of the deduction, but most small businesses won't be affected by these limitations. But you need to be aware of it, that as your business grows, Section 179 considerations might change pretty dramatically. So what can happen is that under the, business income limitation of Section 179, it cannot cause an overall business tax loss for the year. It can only take you to zero. It can't take you beyond that. So specifically, Section 179 for the tax year cannot exceed the aggregate taxable income for the active conduct of trade or business during that tax year. So the rule can potentially affect small businesses. So if you're married filing jointly, you include your spouse's business income, W-2 income, and Section 179 deductions, if any, in determining whether the business income limitation affects you. So there's a lot of things kind of coming together that might be separate from the P&L of one single entity to determine. So, and then what really gets kind of difficult too is that the limitations are applied not only at the business level. So say you've got an S corporation, you have section 179 to think about there, but then that same limitation is also going to apply at the 1040 level. So on the K1, you send out the section 179. Then on the 1040, you've got the same issue that's going to like have other entities coming into play. So if you have a big loss from one entity, you're going to potentially reduce your capacity for section 179 from another entity. So that's where, if you've got several things coming together, you really need to like be tinkering with it and be thinking what makes the most sense. So that's the thing about it, is that section 179 has many, many more nuances. But also one thing to know is that most states do not conform to any amount of bonus depreciation. Basically, if you take bonus depreciation, that asset does not get accelerated depreciation at almost any state level. Most states do not conform to the bonus depreciation rule in any capacity. So you end up going back to just standard depreciation at the state level. For section 179, states have many more considerations for it. That's probably how I would say. Some of them will cap it at the old rule, which was $25,000. Other states will do, maybe slightly more, up to $100,000 or something like that. So that's to say, in working with my clients, if we're choosing to take the most aggressive depreciation path, I will oftentimes use an asset that has, I'll claim section 179 on an asset up to the available maximum at the state level, and then use bonus depreciation on everything else. Just because they're like, we're gonna basically get that extra $25,000 pop of expense on the state return. Otherwise, if you just, most practitioners, if you just pop it into the software, it's gonna default to bonus depreciation, because bonus depreciation applies automatically, and you elect out of bonus depreciation. But that's something to think about, is like actively choosing that sort of setup for your bonus depreciation versus section 179. Now, when it comes to section 179, there are other elements that make it kind of a better planning tool. So if we are going to be subject to self-employment tax, so if we have a sole proprietorship or disregarded entity, or if we're working with partnership entities that are going to be passing through self-employment earnings, section 179, as noted earlier, cannot create a loss for a business. It can only go down to zero. It doesn't create a loss. And so what happens when you have section 179 that's claimed in excess of your business income, that deduction carries forward. The section 179 carries forward as its own tax attribute. And so the good thing about that is that we go to zero, but we don't lose the attribute. We can maybe claim it in a future year. The good thing about that is that in that future year, when we claim it, if we're subject to self-employment tax, it's going to reduce the income subject to self-employment tax, which is a really good thing. If we're using bonus depreciation to create a loss, that loss in that single tax year in business income does not carry over at the level of self-employment tax. Self-employment tax does not look across years. It only looks at the single year to say, did you have self-employment income? And if you did, we're going to tax you on it. So it doesn't consider any losses from prior year or anything like that. So that's the thing when it comes to self-employment tax, is you have to remember, is it's like in an isolated year, what is going to happen? Section 179, the way it carries over is that it is going to reduce the self-employment income and the related tax in a future year. Bonus depreciation, if you create a loss, it only takes you kind of to zero. You don't get a credit or any sort of refund for self-employment tax. And then you've claimed all those deductions now, so you've reduced your deductions in the future, which creates your greater exposure for self-employment tax. And so that's one thing that we need to think about, is what is going to happen to our self-employment tax. This is where going to zero might be what we want. We don't want to go to negative, though, because if we go to negative, we might be increasing our lifetime self-employment tax unnecessarily. So that's the thing to know, is that section 179, because it doesn't take you to zero, you could have some better planning opportunities. Bonus depreciation, as noted, will take you below zero, which is fine in the sense that it's going to create, some sort of net operating loss potentially that carries over. In a C Corp context, Or you might have in a, if you've got a lot of businesses with losses for, so whatever reasons at the 1040 level, you can create, an excess business loss rule that might be coming into play. We'll talk about that in a second. But regardless, if you create an NOL, the problem with that is that NOLs do carry over indefinitely. However, they're only available to shelter 80% of the taxable income in a carryover year. So say you get a huge loss in one year, the next year you got a huge bump in income. Now only 80% of that NOL is offsetting the future year. And so that's where bonus depreciation, even though you can take all of it in one year, you might be only able to offset 80% of the income in the next year using those same deductions. So for Section 179, though, if you exceed your taxable income, that tax attribute does not create an overall NOL. It just creates a Section 179 carryover to future years. And so Section 179 deductions, for that reason, can't create an NOL, and they'll always be able to offset the income to zero. And so that's the really big benefit there. And so I just make that note that if we're talking about being in loss positions and all those sorts of things, and we know that we're going to be there, it's worth managing our depreciation choices to not create losses that might hurt us in the future. So everyone's like, I pay no tax. And it's like, we can pay, quote unquote, no tax without hurting our future self. So, or that sort of thing. So in any given tax year in isolation. Then again, we also, in this whole context, want to be thinking about, do we want all these depreciation deductions at what is functionally a very low tax rate? And in the future, you're potentially creating higher tax outcomes for us. Eyes wide open, and it's really good to be planning all of these things. So as I mentioned a moment ago, the excess business loss rule. So both first year bonus depreciation and Section 179 deductions can trigger excess business loss rule for individual taxpayers. So an excess business loss is the excess of your total business income losses for the year over, a threshold. So for 2025, the thresholds were, 313,000 for individuals, 620, for non-married couples, married couples, 626. 2026 is going to be 256,000 for non-married couples and 512,000. So it actually dropped back with the OBA, the One Big Beautiful Bill legislation. So if you have an excess business loss, it's treated as an NOL and carried over to later years. Similarly as just discussed, the requirement that you must treat any excess loss as an NOL forces you to wait at least 1 year to get any tax savings benefit from an excess loss. The other effect of the excess business loss is that the excess loss cannot reduce your self-employment income, as previously mentioned. It basically is a separate attribute that has nothing to do with your self-employment income. So when we think about managing self-employment taxes, we really have to understand the fact that it's kind of its own set of rules that are different from necessarily income tax. And so you have to plan accordingly. So all of this is just so this video is basically, to discuss the interplay and where we might choose one versus another and all those sorts of things. And to understand that there's a lot of nuance that can go into making these decisions around depreciation. Sometimes it can be you could get pretty granular with it, but when it comes to planning, we also need to think about the fact that, business never goes exactly as we plan. And so for that reason, we need to be agile as well. So when we think about planning, it needs to be kind of a living, breathing process and not so much in isolation, because Q1, you might be making certain choices, and by Q3, you might be projecting different choices. And so all of this has a lot to do with where is the business going, what's the economy doing, all those sorts of things. So if you want to talk about any of these rules or anything that might be specific to your tax planning scenario, feel free to grab the link to the website and book a call at your convenience. But otherwise, I will have a new video for you soon. Take care.